In the alternate version of exercise 10-9, we're presented with a situation where Shea is going to retire bonds early. On January 1st, 2016, they issued 360,000 11% 20-year bonds at a price of 97.5. Then we fast forward 6 years later on January 1st, 2022. Shea is going to retire a quarter or 25% of these bonds by buying them on the open market at 104.75. All interest was accounted and paid for through December 31st, 2021, the day before the purchase. It also indicates that we're going to use the straight line method in order to amortize any bond discount or premium. So eventually we want to work towards the gain or loss on this particular retirement and the journal entries, but we've got a few steps in between to collect some information we need. The first step is, how much cash did the company really receive when it issued the bonds on January 1st, 2016? Recall from the chapter, we take the par value, which in this situation is $360,000, times the selling price, which is often stated as the percentage of par. Here it notates that's 97.5%. So 360,000 times 97.50% equals 351,000. That's the amount of cash that Shea actually received. This is a discount situation. How we know that is because the amount of cash received is less than the par value. Now, we don't know 100% what the market value is. It doesn't indicate what the market percentage is under the scenario, but I can say because it was issued as a discount, we do know that the market value is something above the contract value of 11%. Whether the market value is 12%, 15%, couldn't tell you exactly, but it's something above the 11%, which is why it's been issued at a discount. The next part asks us, what is that amount of discount at January 1st, 2016? It's pretty easy to calculate. Take the par value of 360,000, subtract out the issue price or amount of cash they received on January 1st of 351,000, and that gives us a total discount of $9,000. So doing one more step to work towards it. The next question says, how much amortization of the discount is recorded on the bonds for the entire period from January 1st, 2016 through December 31st, 2021? Keep in mind that the discount is a contra liability account. It's reducing bonds payable on our balance sheet, but slowly over time from January 1st through 2016, through the life of the bonds or however long we hold on to them, slowly that's lowering. We mentioned we're going to use straight line in order to amortize that. Now, we're looking at not the end of the life of the bonds, but the retirement period for a portion of the bonds, which is December 31st, 2021. We want to figure out how much of that discount was amortized in that 6-year window. So let's start out with saying, again, the total amount of the discount is $9,000. If we divide that by the term of the bond, which is going to be 20 years, we mentioned 20 years, take $9,000 by 20 years, that means every year over those 20 years, if we had held on to them for 20 years, we would have amortized $450 of the discount. Keep in mind, however, that a portion of these was sold within 6 years. So we take the yearly straight line amortization of $450 times 6 years, the retirement period. Amortization on the whole entire bond issue for that 6-year period through December 31st, 2021 is $2,700. Just 450 times 6 equals $2,700. So we're edging a little bit closer each time to the information that we need. Although not asked, again, this said how much amortization was recorded. Although not asked, this is a piece of information we'll need to continue moving forward with the problem. How much discount is remaining? Remember, we start with $9,000. We indicate for the whole entire bond issue, we're going to amortize $2,700. $9,000 minus $2,700 would mean that as of this date, there would still be an unamortized bond discount appearing on our balance sheet of $6,300. So, what's the carrying value or the book value of the bonds, the whole entire bond issue, and also the carrying value of the 25% soon to be retired bonds as of the close of business on December 31st, 2021? So let's look at the whole entire group of the bond issue. The par value of the whole entire bond issue was $360,000. We just calculated that the remaining discount, that's why I calculated it here, is $6,300. If you recall, a bond discount is a contra liability account, so that's going to subtract from that par value or that bond payable on our balance sheet in order to get carrying value. So we'll take $360,000 minus the discount of $6,300 means the whole entire bond issue is showing a carrying value or book value on our balance sheet of $353,700. Now that's the whole entire bond issue, but we're concerned with the retirement, and that's 25% or 1/4. So let's take this whole entire group, all three of these numbers, and multiply it times 25%. 360,000 times 25% equals 90,000. The remaining discount of 6,300 times 25% is 1,575. And if we take $90,000 par value of that 25% retirement minus that portion of the discount, which is 1,575, for just that portion of the retired bonds, they have a carrying value on our balance sheet of $88,425. So we're getting a lot closer. So let's continue to move forward. How much did the company pay on January 1st, 2022 to purchase the bonds that it retired? So we've already isolated what the carrying value is, but now we want to isolate what did they actually have to pay in order to retire those bonds. Well, we're going to take the par value of the retired bonds, which is $90,000, times whatever the purchase or selling price was as a percentage of par. Over here it indicates that they had to buy it back at 104.75%. 90,000 times 104.75% equals $94,275. So that's how much they had to pay in order to retire them early. And it makes sense that you would have to pay a premium because the bondholders expected to get interest for that additional period of time. So it makes sense to have to pay them a little bit extra to retire it early. So edging even closer. Now let's do a comparison between what they had to pay to retire them and what's still on the books in order to figure out the gain or loss for the company. So what's the amount of gain or loss? Well, the carrying value of the portion of the retired bonds on January 1st, 2022 is $88,425. If we can compare that to the amount paid to retire them of $94,275, the difference is $88,425 minus $94,275 is a difference of $5,850. We show that as a negative amount. This is considered a loss on retirement. If you step back and think about it, the amount that they had to pay in order to retire those bonds was greater than the carrying value. So that's going to be considered a loss to the company because they had to pay more than what really existed on the books at that point in time. So we're edging still a little bit closer. Now, we are also asked, last and not least, to prepare the journal entry. Last step that we have to do. So we're going to debit bonds payable for that portion of the par value of the retired bonds. So we're going to debit bonds payable for $90,000. Let's go ahead and take care of the remaining discount, that contra liability account discount on bonds payable. Remember, it has a normal debit balance, so we would reduce it. We want to take it off because those bonds aren't still outstanding by crediting discount on bonds payable for the remaining amount of $1,575. We also need to record the loss on retirement. Loss is a type of an expense account. We increase it with a debit. So we'll debit loss on retirement of bonds payable for the $5,850 we just indicated in step number 6. We're not quite balanced yet. One other piece of information is we need to credit cash. Remember, they're having to pay this, so it's that much less cash they have. Credit cash for the whole entire price that they have to pay in order to buy them back, which is a credit to cash of $94,275.